You might think that I'm negative all the time. Well, it's really not true. I just work at a boutique firm where I can say really what I believe. I come from large companies, I've run large mutual funds, but I work for a boutique firm that can say what we really believe and then position our clients properly given the market environment. So we think currently we have maybe a 5 or 10% correction that might be coming soon. And we want to highlight a really cool stock that we think has significant upside. So, walking through kind of an update of what we think is going on, we're basically ready to pull the trigger on reducing our equity exposure and either protecting that capital with a hedge in the portfolio or putting that money into treasury bills and getting over a 5% yield currently. Now the markets are higher. They have higher valuations, obviously, with bond rates moving up. The 10-year treasury has moved up to 4.1%. The higher valuations are becoming a problem because it can't be supported by the lower yields on bonds. And I'll walk you through that here in a little bit. So the market needs, once again, to have higher than expected earnings when the earnings kick off later this week. The earnings expectations are much higher than what they were in the prior quarter, and the AAII investor sentiment is now pretty bullish. So bullish is not a positive thing, bullish is a negative thing. So the bullish ratio is 46.4%, and the bears are only 24.5%. That's almost a 2-to-1 ratio. That gets to the point of becoming a negative for the markets. We're expecting some sort of 5 or 10% pullback. Not sure the timing, but we would maybe expect the markets to move up into reasonably good earnings and then have a problem with the Fed tightening again on the 26th of July. The technicals are still positive, so as long as the technicals are positive, stay with it. When the technicals roll over, act quickly. We're hearing whisper numbers on NVIDIA. Now, NVIDIA doesn't report until August, but the numbers are as high as 15 billion for the quarter. Let me step back for a second. So last quarter they reported 7, which was a better than expected number. They guided to 11 billion, which was a major increase, and then now we're hearing potentially 15 billion. We don't think they're going to report 15 billion. We think that the expectations are just getting too high. Keep in mind, Amazon has a competitive chip to NVIDIA. Now, we don't have any details about this chip, but Amazon's starting to talk it up. They think it's a potential killer for the group. Keep in mind that they are in that cloud computing space, i.e., artificial intelligence. You can see that it's averaged 2 to 3% for a very long period of time through here, right? Sometimes higher, so as high as 5%, where the Fed was starting to raise rates in 2005, 6, and 7. And then it took a severe recession to occur to get that 5% inflation down. And you can see that inflation has been lower, and then now got as high as close to right around 9% and has started to roll over. We think the trend is down, so the trend inflation will come down. But to help out the market valuation with roughly 19 times earnings, you're going to have to see inflation below 3% and the market to have comfort in the economy at the same time. So this is a problem for the stock market. The core inflation has been stickier than what's liked and has been, last month has been over 5%. This month looks like it's going to be right at 5%. So it's not coming down very fast. Consumer credit rates. Now, I was rather surprised when I opened my mail. I'm doing this on purpose to see what the credit cards are starting to charge. I got one solicitation that said, if you have bad credit, X, Y, et cetera, your rate could be as high as 40% on a credit card. Could you imagine having a 40% rate? Maybe your rate was somewhere in the teens and it jumping to 40% for whatever reason. Credit card rates on average are now at 20%. That's a very significant pickup. There's $1 trillion of credit card debt out there, and obviously a lot more in mortgage debt and other debts. But as rates rise, this is a problem for the consumer and businesses. The Federal Reserve meeting is on the 26th, where they'll likely come out and raise rates by 25 basis points. We think the market's going to really struggle with these higher rates and the economy. Now, we talked about the stock market and bond market valuations. With the 10-year Treasury up at over 4%, this is a problem. We discussed this in the past. That really becomes somewhat of an issue at 375. It becomes a concern, a real concern above 4%, and becomes a real severe problem at 4.25. Right now, if you do the earnings yield of the stock market, so it's the inverse of the PE of the stock market. So you do 1 divided by 19.1, which is the PE of the stock market, you get roughly 5.2%, which is the earnings yield of the S&P 500. You compare that with the 10-year Treasury of 4.1, you get a right around 1.1% spread between the two. The market has been right around 1.6% spread between the S&P 500 and the 10-year Treasury. So that spread has really shrunk. That's an issue for the valuations of stocks. So to get the valuation back to where it should be without anything else happening, the S&P 500 needs to decline roughly 8.4%, or earnings need to be higher by 8.4% over the next 12 months. We don't see that as likely happening, as the expectations are already built into $233 over the next 12 months earnings, and that earnings growth is pretty substantial, which we kind of doubt will happen anyway. So the earnings being a lot better than expected is just not going to happen. So we're concerned that we are going to see a pullback in the stock market in a reasonably short period of time. Now here's our buy. So Levi's. We like the brand. It's a great brand. It's well known worldwide. We've known the stock since they've gone public. We've followed it very closely. We think there's a lot of growth opportunities in Levi's as they come out with new products, new brands. It's a really interesting company. Again, high quality company here. We've watched this very closely, this company, and wanted to buy it for a long period of time. And it's doing what we like to see, to get kind of a toe stubbing. It hurts, but it doesn't kill the company type of move down in the stock. On average, this stock is traded right around 17 times earnings. It's currently right around 10 times earnings. It's been as high as 30 times earnings. We see the stock at $23, so it's currently $13, $23 over a 12-month period. So right around 17 times the 2024 earnings of $1.37, or up 70% in a high quality stock. We like to give you guys high quality companies that have a lot of upside potential. You just have to be patient with them and let the fundamentals play out. Let me back up a second. 2 weeks out, we're going to talk about the presidential market cycle. I really enjoyed putting this piece together. There's some really interesting points to be made here, and I'll just highlight a couple. Okay, during the presidential market cycle, traditionally the fourth year, which is what we're going into, has higher volatility. And then the year after the election, there's generally a recession about 60% of the time. So we're entering that fourth year with a likely recession coming and very high stock valuations currently. So the Biden team has put out the phrase Bidenomics. We think that's a big mistake. They ought to rethink that. It might be the worst political marketing idea of all time. We think the slogan, it just stands out for us. the slogan's going to turn into Brandonomics. That's not a very flattering term if you're a Democrat. So the Biden economic plan has been really centered around high government spending, high regulation, pushing what they think they want to achieve in terms of green energy. So high regulation around that and very restrictive growth policies. Just keep in mind that we do think a correction is coming in short order to be followed by a recession probably sometime in 2024. It could happen in 2023. And there's more volatility coming in the stock market. Just be careful. You've got an opportunity to maneuver quickly as potentially the market moves up into earnings and become more defensive as we enter 2024, which is likely to be a really tough year for the stock market. Please hit like, go to my website, Patrick Adams, CFA, and sign up for Market Minute. You'll get an email from us every week, and we hopefully this was helpful to you, and look forward to talking soon. Take care.